for the jobs. Now, here's why all of this is so important. Take a look at this chart right here. This is directly from the Federal Reserve's official database. Each one of these little shaded areas right here represents a recession. And what do you notice right before or during every single one of them? There's a spike in unemployment. From the 1970s oil shock to the 2008 financial crisis to the COVID crash in 2020, the pattern is almost always the same. The job market starts to break, unemployment starts to go up, and then all of a sudden we find ourselves in a recession. Now, right now, the unemployment rate sits at around 4.2% as of July 2025. Now, that's not really something to worry about yet, but when you combine all of that with the May and June job numbers, which show essentially zero net job growth, then it starts to really paint a scary picture. And this is what economists and investors are afraid of. Now, if these 2 months lost us over 250,000 jobs, it makes people wonder, maybe we're already in a recession. And did the Fed miss cutting interest rates? So there's a lot of really interesting theories here. But what seems to be true is that we lost around 89% of jobs in just May and June. And the first question is, what was the reason for how much the government changed their numbers? And here's what they're telling us so far. According to the Bureau of Labor Statistics, these revisions were just part of the normal process. Every month, the BLS gets more complete data from businesses, government agencies, and payroll companies, and they update the numbers as that data comes in. So the story that they're sticking to is the first numbers were based on just early guesstimates of what they thought it would be, and once more employers submitted their info, the revised total came in way lower. They also pointed out to something called seasonal adjustments, which is a statistical model that's used to smooth out things like school activities and holidays and weather and things like that. Now, in theory, these adjustments are supposed to help us see the trend, but in reality, especially in 2025 with changing immigration policies and tariffs and remote work and automation still changing our economy, these models might be completely off. And that's where the real problem is, because the Federal Reserve has been telling us that the labor market is too strong to justify cutting rates.
Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment.
But what if it's not? What if